Welcome back to Investing Talk Podcast.
Today we're looking at RKLB.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep the lights on and the analysis coming.
It does. And frankly, this feels like a massive moment. We're sitting here, it's Sunday, February 22, 2026.
Right.
And we're just days away from their Q4 and full year 2025 earnings report.
Yeah.
The tension is, well, it's palpable.
It really is. My inbox is completely flooded.
Yeah. So let's set the stage for where we are right now. If you've been watching the ticker, you know they've had an absolutely incredible run over the last year. I mean, doubled year over year.
It did, yeah.
And there's always a but with these high-growth stocks. It's currently sitting about 30% off its recent highs.
And that 30% is exactly why people are freaking out. It raises the big question you have to ask yourself. Is this a falling knife that's going to slice your hand open if you try to catch it? Or is this a massive discount on a generational company?
Right.
Because, let's be honest, the volatility lately has been enough to make you nauseous.
It's been intense, I agree. But I think the mistake people make is getting fixated on the daily price swings those red and green candles and forgetting to actually look at the business underneath it all.
Easy to do when everything is blinking red.
Exactly. But the story here isn't just about launching rockets anymore. If you still think of them as just a launch company, you are completely missing the moat they've built.
Okay, so what is the moat then?
We're talking about an integrated launch-to-spacecraft ecosystem, and crucially, they have successfully pivoted into defense and hypersonics.
Okay, hold on. Let's unpack this. Because ecosystem is a great buzzword that CEOs love to throw around to distract us from burning cash.
That's fair.
Before we get carried away with the defense pivots and the sci-fi stuff, we need to look at the cold, hard numbers. Let's dive into the fundamentals.
Okay, let's look at the scorecard. If we look back at Q3 2025, the growth is undeniably showing up in the revenue column. They posted record revenue of $155 million. That's a 48% increase year over year.
Nearly 50% growth.
Exactly. That is not a small startup just, getting lucky.
Yeah.
That is hyperscaling.
Right, the top line growth is impressive. I will give you that. 48% is a big number. But I have to play the skeptic here.
Go for it.
Revenue is vanity, profit is sanity. Where is the actual profit? Analysts are expecting a loss of roughly 5 cents per share for Q4.
Yes, they are.
So they're still burning cash. At what point does this massive revenue machine actually spit out earnings for the investors?
That is the classic criticism, and it's a fair one. But you have to look at the margin story to understand the path to profitability here.
Yeah.
It is improving significantly.
How significant?
In that same Q3 report, their GAAP gross margins hit 37%. And management is explicitly targeting 45 to 50% margins as the Electron launch cadence speeds up.
Wait, 37%? That is surprisingly high for hardware. Usually hardware is an absolute grind.
That's the key. 50% is software territory. If they actually hit that, they are priced completely wrong right now.
But how do they get there? I mean, is it just launching more rockets? Economics of scale?
No. And this is where that ecosystem buzzword actually means something tangible. Think of it this way. Most launch companies are like a taxi service.
Okay.
You pay them to drive your satellite to orbit. They drop you off. And that's it. Transaction over. RKLB is different. They are building the car, they are driving the car, but they are also building the passenger.
The passenger. You mean the payload?
The satellite itself, yeah. They make the solar panels, the reaction wheels, the flight software, the radios. So when a customer comes to them, they don't just say, hey, we'll launch you.
They say we'll do the whole thing.
Right. We will build your spacecraft, we will launch it on our rocket, and we will operate it for you using our software. They capture value at every single step of the chain.
Okay, that makes a lot more sense. It's like the IKEA of space. You don't just buy the delivery, buy the whole living room set.
Exactly. You are the supplier. You aren't paying suppliers. That's how you get to 50% margins. And the safety net underneath all of this construction is their backlog.
Which is massive right now, isn't it?
Huge. They are sitting on a contracted backlog exceeding $1.1 billion.
Over $1 billion locked in.
Over $1 billion. And a huge chunk of that converts to revenue over the next 12 months. So that's locked in money. It's not hypothetical sales projections, it's signed contracts.
Okay, that backlog number does give me some comfort. It means they aren't waking up next month wondering where the rent money is coming from.
Exactly.
But let's check the financial health here. Can they actually survive the burn rate long enough to fulfill that backlog? I'm looking at the balance sheet right now. Quick ratio is 2.83, current ratio is 3.18.
Which is very healthy.
Yeah, for the listeners who might not be glued to accounting textbooks, let's explain what that means. A quick ratio of 2.83 basically means for every dollar of short-term debt they owe, they have $2.83 in liquid assets.
Cash or things they can sell tomorrow.
Right, to pay it off.
And usually anything over 1.0 is considered safe. Seeing it nearly at 3, that is a fortress balance sheet.
It really is.
It tells us that even if the economy falls off a cliff tomorrow, or the credit markets just freeze up completely, Rocket Lab has enough liquid cash to keep the lights on.
So they aren't desperate for cash. They're not going to dilute shareholders tomorrow just to survive.
Far from it. And it's important to note where that cash is actually going. They aren't lighting it on fire with lavish parties or whatever. It is being deployed aggressively toward neutron development.
Their massive new rocket.
Right. And fulfilling those government contracts. They aren't paying dividends or doing stock buybacks. They are reinvesting every single penny into the next generation of vehicles.
Okay, I can acknowledge the prudent cash flow management. They aren't being reckless, even if they are technically unprofitable today.
Yeah.
And with an enterprise value hovering around $37 to almost $40 billion, the market is clearly pricing in a lot of that future success. But valuations can be really tricky. Just because the company is healthy doesn't mean the stock price is right.
Mm-hmm.
So let's pivot to the charts and price action, because that is where the pain really is right now.
Oh, the chart has been a wild ride, to say the least.
Wild is putting it mildly. I mean, if you were holding this stock in February 2025, you were looking at $28.62.
Right.
You were pretty happy. Fast forward a year, and it hit a high of nearly $99.60. That is a massive move. You felt like an absolute genius.
You did.
But now we are trading back down in the high 60s. That is a gut check drop. That's the kind of drop that makes you question your life choices.
It feels painful if you bought the top. Absolutely. No one likes seeing a sea of red in their portfolio. But if you zoom out, you have to look at the broader structure.
Okay, what is the structure telling you?
It argues for a preservation of the higher time frame bullish structure. The stock went parabolic. It basically went straight up.
Yeah.
The callback to the 60s is consolidation. It's not necessarily a crash.
We're blowing off steam.
Exactly. It's the stock catching its breath after running a sprint.
I see the logic, but let's look at the moving averages. These are the trend lines that all the algorithmic trading bots watch. What are they telling us?
The technicals are actually still supportive, despite all the scary headlines you see. The 50-day moving average is sitting at $76.52. That represents the short-term trend.
Right.
And the 200-day moving average, which is the long-term trend, is down at $59.80. Since the short-term average is still comfortably above the long-term average, that implies the underlying momentum is still bullish.
Yeah, but the price is below that 50-day line right now. It's trading in the 60s, and the 50-day is up at 76.
It is. And that signals near-term weakness. The traders are nervous. But as long as it holds above that 200-day line at roughly $60, the long-term trend remains totally intact.
So 60 is the floor.
That $60 level is the line in the sand. If it breaks below that, then we have a real technical problem. But right now, it looks like a floor.
It's a really volatile hold, though. You see these Friday slides where the stock just dumps going into the weekend. It feels almost personal sometimes.
Yeah, Fridays have been brutal.
And it seems to tumble in sympathy with peers. When AST Space Mobile takes a hit, Rocket Lab seems to bleed right alongside it completely, regardless of their own news cycle.
That's the nature of the space sector basket. You have these ETFs and algos that group all these space stocks together into one big trade. When one goes down, the algorithm just sells the whole basket. It's frustrating for investors who actually know the difference between the fundamental companies, but it creates opportunities if you're paying attention.
Is there any buying pressure fighting back against that, though?
Actually, yes.
Yeah?
Look at the rebound strength. We've seen rallies of up to 9% in a single day recently.
9% is massive.
It is. And interestingly, these rallies are driven largely by geopolitical tensions and rotation into the defense sector.
So war is good for business.
In this specific sector, unfortunately, yes. When the world gets scary, money flows into defense capability. Rocket Lab is positioning itself right there with hypersonics and rapid launch capabilities. When the Pentagon gets nervous, Rocket Lab's phone rings.
That's a grim but, yeah, very accurate point.
Yeah.
But leading into this February 26 earnings report, the options sentiment, the bets people are placing on the future price is incredibly mixed.
Very mixed.
We are seeing whale alerts and elevated flow. Big money is positioning for a massive move, but they can't seem to decide if it's going up or down.
Which is totally typical before a major catalyst.
Mm-hmm.
The market is holding its breath. No one wants to be caught on the wrong side of an earnings surprise.
Speaking of holding breath, let's see what the street is actually saying. Let's move to the market perception and news cycle.
Okay, so the news cycle right now is a fascinating mixed bag. It's honestly like watching two completely different movies.
It really is. I was reading through the recent headlines, and they are basically schizophrenic. On one hand, you have, why are Rocket Lab shares sliding? And all these reports about them tumbling alongside high-growth peers. It paints a picture of a sector that's just losing favor, like the party is over.
But then you counter that with the bullish narrative that is simultaneously gaining traction. You see headlines like hypersonic heat and military pivot.
Right.
The market is finally waking up to the fact that this isn't just about putting nice little research satellites into orbit. It's about national security. The Katsuri-Vex mission is a prime example of this defense utility.
The defense angle is strong, I definitely admit that. It adds a layer of seriousness to the company. But what about the Wall Street pros? The analyst ratings are sitting at a moderate buy consensus.
Yeah.
The average price target is $72.92. Given where we are trading now, in the high 60s, that implies almost no upside. Maybe a few percentage points. That's not exactly exciting for a growth stock.
Well, that average hides the real story, which is the massive divergence in the targets. You have to look at the extremes here.
Okay, like who?
You have Bank of America with a buy rating and a target of $120.
Yep.
That is nearly a double from where we are right now.
Wow.
But then you have Goldman Sachs sitting at neutral with a target of $69.
Why the huge gap? These are both top-tier banks. Do they just have completely different calculators?
They have completely different beliefs about the timeline. When you see smart money disagreeing by that wide of a margin, it tells you that the valuation models are completely dependent on how much credit you give them for the future Neutron rocket.
Oh.
Bank of America believes Neutron will be a cash cow and is pricing it in. Goldman is waiting to see it actually fly before they give them credit for it.
And while the banks fight it out, we have to talk about the absolute elephant in the room. The red flag. The insider activity.
I knew you were going to bring this up.
I have to. It looks terrible. CFO Adam Spice sold over 1.3 million shares. That is roughly $103.1 million.
It's a big number.
103 million. You don't sell $100 million worth of stock if you think it's about to double again next month. That's not just rebalancing a portfolio for tax reasons. That's an exit.
It's a heavy number, I won't deny that.
Yeah.
It creates significant sentiment pressure on the stock. When the guy literally managing the money hits the sell button of that magnitude, it shakes confidence.
Naturally.
It makes you wonder, what does he know that I don't? Especially regarding the Neutron program's upcoming capital needs.
Exactly my thought. Is the cash burn worse than they are telling us behind closed doors?
However, and this is a really big however, you have to balance that insider sale against the institutional holding stability.
Okay, what are the institutions doing?
We aren't seeing a mass exodus of the big funds. BlackRock isn't dumping their shares. Vanguard isn't dumping. Executives sell for a million personal reasons. Diversification, taxes. Maybe he really does just want to buy a private island.
Sure.
But funds sell when the thesis breaks. And right now, the funds are staying put.
Fair point. I guess if the institutions were bailing, the price would be a heck of a lot lower than $60. But it still looks ugly on the tape. Let's shift gears and take a hard look at what could actually go wrong here. I want to look at the bear case. What breaks the thesis? What turns this investment into a disaster?
The biggest risk, without a doubt, is Neutron.
Specifically the delays. We all heard about the stage 1 tank rupture during testing.
Right, and that is the nightmare scenario.
Yeah.
If that rupture indicates a fundamental design flaw that pushes back the maiden flight significantly, the stock absolutely has to re-rate lower.
Because the valuation depends on it.
Exactly. The current valuation of roughly $40 billion assumes Neutron works and flies relatively soon.
So it's a binary event.
It is highly speculative. Either the rocket flies or it doesn't. But I would argue that the market has already priced in a lot of that fear.
You think so?
Yeah, that 30% pullback we discussed earlier. That is the market discounting the risk of delays. The market is saying, hey, we know about the tank issue. If they come out on the earnings call and say, the tank issue is fixed, we are on track, that fear premium evaporates and the stock pops.
Okay, but what about the macro environment? We are seeing general sector rotation. When risk-off sentiment hits the broader market, high-growth space names get hammered first. They are the furthest out on the risk curve. If rates stay high, does this stock suffer?
That is a very valid sector headwind. If the economy turns or interest rates spike again, high PE stocks suffer across the board.
Yeah.
However, Rocket Lab has a buffer that most speculative tech stocks just don't have.
Which is?
That $1.1 billion backlog.
Ah, right. You mentioned that.
A lot of that backlog is government contracts. The U.S. government pays its bills even in a recession. They might cut funding for, national parks, but they rarely cut funding for defense capabilities when geopolitical tensions are high.
And right now, tensions are definitely high.
Very high. That recurring revenue acts as a floor against pure speculative failure.
So you essentially view the government work as a recession shield.
Precisely. It turns Rocket Lab from a speculative, cash-burning tech stock into a reliable defense contractor. And defense contractors tend to do just fine in rocky markets.
Okay, we've looked at the numbers, the charts, the sentiment, and the risks. It's time to wrap this up. Let's move to the verdict. How are we scoring this?
First, a quick reminder of the immediate catalyst. The Q4 earnings are on February 26, 2026.
Mark your calendars.
If you were listening to this before then, watch the guidance on Neutron and the backlog conversion. That is the entire ballgame right there. Ignore the noise, watch the guidance.
Right. So, taking all that into account, the massive revenue growth, the tank rupture, the insider selling, the defense pivot, what is the final score?
I am assigning a bullish score of 8 out of 10.
An 8 out of 10, that is surprisingly high given the tank rupture and the CFO cashing out $100 million. You are feeling optimistic.
I really am. And here's the elevator pitch for the thesis. Rocket Lab is successfully transitioning from a pure launch company to a comprehensive space systems company.
Right.
They have 48% revenue growth, a pivotal role in hypersonics and defense, and a highly credible path to 50% margins. The market is distracted by the tank rupture and the insider sales right now, but the fundamentals are compounding underneath the surface.
So you think the consensus target of $72 is just wrong?
I think it completely undervalues the defense mode. The recent dip is a clear entry point for the long-term believer. If you believe space is the next trillion-dollar economy, this is the infrastructure play to own.
I'll add a caveat to that. For me, this is a multi-year hold. You have to hold this into the Neutron flights. You have to be willing to stomach the volatility.
Absolutely.
But if you are a short-term trader, expect massive swing potential leading up to and right after the earnings. This is not a stock for the faint of heart. It will absolutely test your resolve.
Agreed. It's for the investor who sees where the space economy is going in 2030, not just what it's doing next week.
All right, that's a wrap on the analysis. Just a reminder to everyone listening, this is for educational purposes only. Do your own due diligence. We are just two people talking into microphones.
And don't forget to subscribe, like, and comment below. I want to know, do you think the Neutron delays are a deal breaker, or is it just a speed bump? And does the CFO selling $100 million scare you? Let us know in the comments.
Thanks for listening. We'll see you in the next deep dive.
See you then.